What's up everyone and welcome back to the Money Network. Today we will look into one of my personal role models, the father of value investing, Benjamin Graham. Welcome to the Money Masterminds video series. In each of these episodes we will look into one famous investor and we will look at what incredible wisdom they have to share with us investors. We look at their lives, we look at their investment careers, and of course their books. At the end of this video, I will list all the tips and tricks that Graham has taught us. So keep watching until the end and see how you measure up to a perfect investor. All this information compressed in one short video, so you don't have to do any more research yourself, apart from watching this video of course. You have to like this video and you have to subscribe to this channel. Welcome to the Money Network. Today we will look at the father of investing, the person who brought investing to the common man, Benjamin Graham. He lived from 1894 to 1976. Graham grew up in a wealthy family and he moved to New York just when he was 1 year old. At the age of 9, unfortunately his father passed away, and while the family was rather wealthy at that time, his mother unfortunately managed to lose all of their hard-earned money. She even lent money to invest more in the stock market. In a certain point in time, she even went into debt when her investments turned out to fail. After a very successful education in Columbia University, Graham started working at Wall Street. His career as an excellent investment manager and financial educator further paved the way to his incredible fame. In 1929, Graham has worked for 15 years on Wall Street, but unfortunately, Graham and many other investors at the time lost most of their investments during the stock market crash of 1929, one of the worst crashes in history. And it was directly followed by the Great Depression. This series of unfortunate experiences convinced Graham that protecting your capital is crucial. Building in a safety margin in your portfolio is very, very important. After that, he spent his life working out theories about investing. And he succeeded in doing so. He is now seen as the father of two fundamental investment disciplines, security analysis and value investing. Although revolutionary, his idea is incredibly simple. Any investment you make should be worth substantially more than the money you are putting in. Graham strongly believed in fundamental analysis and he sought out companies with strong balance sheets, little debt, above average profit margins and ample cash flow. Even almost 50 years after his death, Graham is still very famous in the financial sector. His book Securities Analysis, written in 1934, almost 90 years old, is to this day considered to be one of the most influential books in the investment sector. In 1949, Graham wrote his second great book, The Intelligent Investor, a book over 70 years old now that can still be used today when looking for individual stocks on the stock market. The book explains the theory of value investing and how to put the theory into practice. This way is exactly how Graham invested during his life and he made a fortune with his theory. Others have later copied his strategy and saw similar results. People like Charles Munger and Warren Buffett are to this day still strong advocates of his theories. The Intelligent Investor is a nearly 700 pages long manifest, so to save you the trouble of going through it, here are the key takeaways of the book. Stay until the end of the video for an overview of the criteria of a good investor and see how you measure up to an ideal investor. In his book, Graham coined the term Mr. Market, an allegory of an imaginary person that turns up every day on Wall Street and offers to buy or sell his shares at a different price. Sometimes his proposed shares make sense, but more often than not, the proposed prices are off mark. It is widely accepted that Mr. Market always acts irrational and in panic. When bad news occurs, Mr. Market will sell off all his shares at greatly reduced prices. And vice versa, when times are good and good news is released, Mr. Market will always try to offer great premiums on stock prices. He will buy them at a great premium. Of course, Mr. Market is not a real person. but Mr. Market reflects the sentiment of the average investor on the stock markets. When times are good, people keep buying stocks no matter the price. And likewise, when times are bad, people want to sell. They want to sell their stock as soon as possible, even if it means that they are selling with a loss. The intelligent investor knows Mr. Market, and he will try to anticipate its moves. The best thing you can do is perfectly quoted by Warren Buffett. Be fearful when others are greedy, and be greedy when others are fearful. Basically doing the reverse of Mr. Market. The greed or fear indicator tries to show what sentiment is active now at this moment in the stock market. Check this website from time to time to know where we are at. Or if you don't have the time to read up on the markets daily, just keep buying at a specific point in time, for example, every first day of the month. This way you will have luck buying at lower prices, but you will also sometimes buy at higher prices. The dollar cost averaging method guarantees an average buying price over time. As said before, Graham is known as the father of value investing. But what exactly is value investing? Well, value investing is deriving the intrinsic value of a common stock independent of its market price. You reach this value by analyzing a company's assets, their earnings and their dividend payments. This particular ratio can then be compared to the actual market value. If the intrinsic value is higher than the market value, you are basically buying the stock at a discount. Buying at a lower than market price would be smart if you expect the market price to catch up with the intrinsic value. Graham is looking for stocks that are trading at 2/3 of their intrinsic value, a very rare occurrence in current times. At the end of this video, I will show you an alternative to this rule so you can apply it yourself. Graham also proposes a margin of safety or room for human error. Creating this margin of error can be done by buying stocks that are undervalued, they pay out high dividends, or have low debt to equity ratios. The margin of safety is used to protect the investor's money in case of a bankruptcy of the companies in your portfolio. Another great tip of Graham is to invest in dividend-paying companies. And of course then reinvesting the dividends into the company. Not having to sell your stock for a return, but receiving dividends every year or every few months is a great way to build up your passive income. Of course, here in Belgium we are heavily taxed on our dividend income. So for us, it's better to buy a tracker or a fund that invests in dividend-paying companies but does not pay out the dividend. If the tracker fund is an accumulating fund, you are automatically reinvesting your dividends paid out in the fund, and you're not losing any money due to the taxes on dividends. So Benjamin Graham, father of all investors and a great inspiration to everyone who wants to build up their wealth using the stock market. We looked at his theories. So now let's translate them into an easy checklist to see if you are a good investor for the future. A successful value investor is someone who trusts their own decisions, who is disciplined, and who wants to read up on a lot of information about the companies they want to invest in. He's also someone who is not afraid when times go bad and temporary losses may occur. Further, the successful value investor looks for companies that are stable, they pay out a high dividend, and are not growth companies. Because growth companies pose too much risk, according to Graham. The successful investor builds up a portfolio that focuses on the protection of the capital that it was initially invested. It also focuses on investing in the long term, and the portfolio always has invested at least 25% of its value in fixed income and stocks. The portfolio also buys stocks that are undervalued on the stock market compared to their current intrinsic value. Another very important point of Graham is the diversification across the different sectors of the world. Applying these tips and tricks will improve your advantage as an investor. But as said before, Graham's tips are 70 years old. Even though they stand up against the test of time, new products have entered the markets by now. New products that combine a lot of Graham's tips already. Worldwide trackers nowadays offer the same pros and get rid of a lot of the required time for the investor. Trackers will offer you a global average return for little to no effort. Sure, the markets can still be beat using Graham's tips, but nowadays they are only used by a very select few. So what do? Do you select individual companies? Do you do your research? Do you read up on those companies? Or do you just invest in trackers for the ease of it? Let me know in the comments below. I thank you very much for watching, and until the next time.